Welcome you all in another session of hedge fund accounting, and this is a third module where we are going to discuss about different strategies, investment strategies of hedge fund. So let's start with the discussion. What are and let's decode what are the different strategies and how the hedge fund managers they invest, or I would say they actually do some sort of research on their own and find out potential in cumulative stocks or different financial instruments to generate more returns to their investors. So let's start with the discussion. When we talk about investment strategies, there are investment strategies, right? Fund manager use their expertise to find potential uh, their investment opportunities, as I said, and deploy investors capital to generate alpha, or I would say to generate more returns. If you see the structure, already we have discussed the structure of hedge fund. Basically, general partners and limited partners, they invest funds in hedge fund schemes, and hedge fund managers, basically again general partners, use their investment investment um, investment, I would say, expertise or strategies to deploy that funds in across different sectors or even financial instruments or different asset classes. When we say asset classes, so it means we are talking about currencies, equities, bonds, debentures. Those instruments comes under your asset classes. So basically, fund managers invest that an amount in different variety of sectors, then variety of different financial instruments, and generate capital plus income to their investors. So that's how investment strategies come into picture. But when you work on capital investing part, you should have a standard procedure in place, so which you can follow it continuously. You can follow it, and once you follow it, automatically it will help you only to manage that, I would say, or generate that more returns on investment. So with regards to that, when we talk about strategies, we have different strategies. So let's discuss that. What are those strategies and all? The first strategy that we are going to discuss about is equity driven strategy. Equity driven, it means, so when fund manager raise capital from let's say investors, fund manager will raise capital from investors for let's say for investment in equity or equity related companies. And here definitely fund manager will identify potential sectors like renewable energy, automobile, metal, energy, commodity, right? So those are the sectors. So they'll first select the sectors, then companies from that particular sectors, and they'll invest. Anyways, if any fund is focusing on equity, any fund is focusing on equity, means buying and selling of equities, so that fund would be your equity based funds. And again, if any fund is investing in equity only, so that would be your hedge fund equity based investment strategy. So basically here fund manager will target the equity portion, so they'll directly purchase the equity of TCS, equity of Wipro, equity of, let's say, Infosys. So they'll directly purchase it. All right, so that strategy would be your equity investment strategy. What about next? Let's say next is event driven strategy. We have an event driven. Event, it means activist, credit arbitrage, distress, restructuring, merger arbitrage, private issues, regulations, special situations, and multi strategy. I'll just quickly decode it, what it means event driven. For example, let's say merger and acquisition, or maybe ahead of IPO. So most of the companies ahead of IPO, most of the funds ahead of IPO, they even raise the invest the fund, and even they raise the funds. Why? Because in an IPO event, so they'll get the opportunity to earn the valuation on equity or appreciation of equity, and that's what they target such a companies. What about merger and acquisition? If you see any event as such where one company want to acquire to another, again hedge funds target to those companies and invest into it. So ultimately my point is, ahead of any events. It can be even, global geopolitical issues. For example, let's say Hamas and Israel strike, or Russia or Ukraine war, or maybe Pakistan or Sri Lankan government's bonds. So you would see that. So those companies or countries, now they are under debt. So it means any point in time it can happen. Anything means anything. They can announce even default on payment on insolvency as well. So the point here is, ahead of events, if any fund is taking opportunity or looking opportunity to invest in such a events, or before the events, so that funds would be your event driven funds. Event driven, it means they'll only focus on events and invest it and generate the more returns to their investors. All right. So third strategy would be active trading, macro strategy. Macro, it means here, if you see, there is no any specific pattern that you would see. They can target even they can target your trading into derivatives, trading into different financial instruments, or maybe commodities in derivative instruments. It can be anything. Macro, it means big, mass, right? You would see multi-strategy or multiple things, where hedge fund will focus on multiple things. Let's say if they see any potential in derivative market, then fund manager will focus on derivative market and raise funds. If you see, if fund manager sees any potential opportunity in metal, they'll focus on metal. We have seen that before the pandemic, the market was different, but after pandemic, the market was different. All right, same thing. If you see, if we can relate with the Ukraine and Russia war, so that affected on oil prices. Now, current burning issue, if you see, Red Sea issue, where Hamas or the other terror outfits, they're targeting supply chain. They are looking for how they can disrupt the world's supply chain, and if that happens, see, fund managers, they always look for different opportunities, as I said. Then definitely they'll invest in supply chain companies. They'll invest in oil companies and all. If the oil chains disrupt, then ultimately oil prices will go up. So basically, when we say macro, it means hedge fund managers, they'll focus on multiple things, and that strategy would be a macro strategy. Then what about relative value? Relative value, it means the fixed income securities. So that you can say, if any fund is focusing or investing in government securities or fixed income securities, then that investment strategy would be your relative value. If you invest in, let's say, government bonds, or if you invest in any corporate bonds, or if you offer any loan credit facility to any funds, so, or any companies, that becomes your relative value or credit fund strategy. And then last one is fund of fund strategy. Fund of fund, it means, it's, for example, let's say GMT fund want to invest in TCS fund, or maybe let's say Tata fund. Those are just names, right? If they are looking for investment, it means investor is investing. See the flow. Investor is investing in GMT fund, and GMT fund is investing in, let's say, Tata fund. So Tata fund will invest in equity. So basically, Tata fund will invest in equity, but investor will invest in GMT fund, and GMT fund will invest in Tata fund. So this is how your fund of fund works. All right. So these are the strategies, so that you maybe see question around it. What are the different strategies, or what it means? Maybe theoretically, or maybe in your interview process, you may expect question around it. So you should know it. What are the different investment strategies, and how investment fund manager manage it? So we'll discuss little more in details as well. So you can try to even write it down if you want. Try to do it. So we'll decode that also. It is kind of more theoretical part, but you should know it, because in interview nowadays, interview or panel, they're asking lots of questions around theoretical side as well. All right. So value investing, again, strategy of those were like standard one, but you would see different names of those strategies also. So let's see this. The first strategy that you would see, value investing. The convertible bonds arbitrage is a mixture of credit investing and relative value arbitrage investing. For instance, a credit fund could take opposing. So it means, if you see value investing, it means if you invest in any convertible bonds or any credit or loans, so that becomes your value investing. So it means if you see any question around value investing. So that investing part is related with your bonds, convertible bonds, and credit investing. So next one is momentum strategy. What it means, momentum strategy, the investment objective of multi-strategy hedge funds is to deliver consistently positive returns regardless of the directional movement in equity interest. So this is a high risk strategy often employed by hedge funds in India and abroad. So most of the Indian hedge funds, they prefer momentum strategy. Momentum, it means if you see any movement in market, so they'll directly invest, whether it is positive or negative movement. So depends on that. Third one, credit arbitrage strategies employ an investment process designed to isolate attractive opportunities in corporate fixed income securities. So this include both senior and subordinated claims as well as bank debt and other outstanding obligations, structuring positions with little or no broad credit market exposure. This may also contain a limited exposure to government, sovereign equity, convertible, or other obligations, but the focus of the strategy is primarily on fixed corporate obligations and other securities are held as component of positions within that structure. So basically, in short, if you ask me what is credit arbitrage, it's a loans. So if any fund is offering loan facility to any company, and if that fund, let's say, raise that investment from the investors to invest in such loans and obligations, so that fund would be your credit arbitrage fund or credit strategy fund. All right. Then next one is global macro. Global macro, it means it's a global macro strategy trade a broad range of strategies in which the investment process is predicted on a movements in underlying economic variables and the impact this have on equity, fixed income, hard currency and commodity markets. Managers employ a variety of techniques, both discretionary and systematic analysis, combination of top down and bottom up this quantitative and fundamental approaches, and long and short term holding periods. So in short, global macro, it means anyways, so you can invest in wide variety of financial instruments by doing a proper research. If you invest it, then that becomes your global macro investment strategy. See, investment strategies are designed on the basis of investments goals, then financial products nature. If you invest in equity, that becomes your equity investment strategy. If you invest in derivatives, that becomes your speculative or risky or derivative based investment strategy. If you invest in any event driven activities, then that becomes your event driven activities. If you invest in loans, that becomes your credit arbitrage opportunity or investment strategy. So basically your hedge fund investment strategies which are based on your investment decisions and product nature. All right, let's go to the next. Quantitative strategy. Quantitative strategy, it means quantitative hedge fund strategies rely on quantitative analysis to market investment decisions. Such hedge fund strategies typically utilize technology-based algorithmic to achieve desired investment objective. Renaissance, basically hedge fund, they have a quantitative strategy. They have their own application. Basically, they use their applications to generate more return. So it means they most of the time they use their algorithms to generate more alpha. All right. Then quantitative strategies are often referred to as black box. So you may expect question around black box. So black box is nothing but it's your quantitative strategies. So black box funds, since investors ordinarily have limited access to investment strategy specifics, such as strategies are normally proprietary and use low latency execution. So quantitative, it means your black box, or I would say algo based trainings, or any hedge fund if they're focusing on algo based trainings, so that becomes your quantitative strategies. So next one is relative value arbitrage. Relative value investment managers maintain positions in which the investment thesis is predicted on realization of a valuation discrepancy in the relationship between multiple securities. Managers employ a variety of fundamental and quantitative techniques to establish investment thesis, and security types range broadly across equity, fixed income, Derivatives or other security types. Relative value arbitrage, it means, so again you can check the fundamentals of different securities or different obligations and invest into it and generate more returns to their investors. So that funds becomes your relative value arbitrage. What about long and short? Long and short investment strategy, also known as equity, hedge strategies. Basically, you can use derivatives, obligations to hedge your portfolio and generate more returns. So that becomes your, equity hedge or long and short investment strategies. So basically, long and short strategy maintain position both long and short in primarily equity and equity derivatives. So this is basically for equity and equity derivatives, but as well as you can also focus on indices as well. All right. So a wide variety of investment processes can be employed to arrive at an investment decisions, including both quantitative and fundamental techniques. Strategies can be broadly diversified or narrowly focused on specific sectors and can range broadly in terms of levels of net exposure, leverage employed, holding period, concentrations of market capitalization, and valuation ranges of typical portfolios. Long short equity managers would typically maintain at least 50% exposure to, and may in some cases be entirely invested in equities and both long and short. So this is what about your long and short investment strategy. But in short, if you ask me briefly how we can understand it, if any fund is selling, equities or buying equities and holding that in portfolio, so that becomes your long and short investment strategies. Then another one is multi-strategy. We have already discussed this. Multi-strategy, it means the investment objective of multi-strategy hedge fund is to deliver consistently positive returns regardless of the directional movement in equity, interest rate, or currency markets. In general, the risk profile of the multi-strategy classification significantly lower than equity market risk. By definition, multi-strategy funds engage in variety of investment sources. In short, so you can design multiple investment strategies and invest in variety of different financial instruments. So that becomes your multi-strategy investment funds. All right. Then what about structures? We have already discussed about the structure, but again, let me just decode it, how it happens. General partners who work as a fund manager, who are responsible for investment decisions. Limited partners like investors, right? They invest in hedge funds, and then hedge fund manager, they basically appoint brokers or open the accounts with brokers for what? So they appoint brokers to help for investments, maybe let's say stocks, bonds, loans, right? And different financial instruments again offer interest payment, dividends, then appreciation and all. And basically broker help fund managers to place money in different variety of financial instruments. And even in accounting also, broker plays crucial role, because as a fund accountants we refer bank statement and broker statements to verify the transactions and create a records in the books of account. All right. They also appoint gatekeeper for trustee, or for maybe for a reporting purpose, and also where they ensure reporting and everything that the admin houses they are doing and providing to them on time to time. So this is how you would see the structures. All right. But there are structures, different structures that you would see, which definitely we'll discuss about it, not in this session, but we'll have a different session on different structures like parallel, then standalone. We have a different structures. Definitely we're going to discuss that in different modules. All right. But yeah, so this is what the structure is. See guys, if you understand the structure, then you can understand the strategies also. And if you don't understand the structures, then you won't be able to understand the strategies. And if you understand the structure, then you can easily relate with your that accounting part as well. All right. So hedge fund, basically fund managers, they apply for a license, and once they have a license, so they can announce different multiple schemes, and then again raise funds. Once they raise funds, then of course they also appoint corporate secretary, then fund accounting house, and as well as they also appoint legal advisors. So where legal advisory teams and then fund accounting and auditing and even the different counterparts, they support fund managers to manage the funds, entire funds and all. So this is how your fund business come into picture, and that's what we see different strategies, because without strategy you cannot generate more returns to your investors. So even in your personal life also, I'm sure if you are a trader, then you would have seen that if you focus on derivatives, equity, this and that, then you cannot generate return. But if you stay focused on one strategy, if you learn each and everything, nut and bolts of that investment strategy, and then focus on that part, I'm sure then you can also generate more returns. See, hedge fund managers, they are like traders, and they know it how to make the alpha, or how to invest money and generate more returns to their investors. So they focus on one segment and understand the each and every aspect of that particular segment. All right. The next part is, you may definitely expect questions around it, like hedge fund versus mutual fund is a difference, right? So you should differentiate that. Who can invest in hedge fund? So only the wealthy people, or the people like who have maintained their the, I would say, minimum level of assets or income, only they can invest it. So as I said, in India you require 1 CR, but in US you require minimum 1 million capital to invest, otherwise you cannot invest. But in mutual fund anyone can invest. So basically this is for poor people, right? That's how you can differentiate. So what can they invest in? So it means almost anything from traditional stocks, bonds to derivatives to life insurance contract where hedge fund invested. But in terms of mutual fund, there are strict legal limitations on what they can invest in, and most stick to the vanilla stocks and bonds. Most of the mutual funds, they only focus on equity and bonds, and little bit loan, but not in a heavy way. All right, that's the difference. So it means hedge funds target anything. They invest in any instruments. What about, so do you know what your funds own? So basically, not necessarily hedge fund doesn't or don't have to tell investors or the government much about what they are investing. So they don't disclose basically. But in mutual funds, they directly disclose. In mutual funds, we have to disclose that everything to the regulators, and that's what mutual funds are regulated one. How expensive are they? Hedge funds are very expensive. Typical fee structure that you would see, 2% of all money in invested, plus 20% profit and even incentive fees. But in mutual funds, moderately, the average fees for a mutual fund is about 0.5% of assets per year. So average that we are talking about. So you might see 1%, you might see 2%, you might see even 3%. But yeah, average you would see 0.5 to 1%, fees where, or cost, which will come for investment. Then what about, is it easy to exit? Of course, in hedge fund, no, there are generally strict restrictions on investors that you would see. You cannot withdraw the investment easily. But what about mutual fund? Yes. If you have, let's say, investment in mutual funds, go and check it. You can quickly take an exit at any point in time. Whenever you want, you can take the exit. All right. But yeah, even though you can sell the mutual fund units to other investors as well. So that is also allowed. But in hedge fund, it's a bit difficult. You can't do it. And that's what they come up with the different regulations. They said they're in-house regulations also. So let's see a few things, similarities as well. So these are the key differences which you would see. Then investors pool money to invest in a basket of securities. Same if I talk about hedge fund, high network investors come together to buy the securities. All right. So it means, let's say, Elon Musk, then big corporate people, they come together and then they basically contribute their funds to target XYZ companies and different things. In mutual fund, anyone having legal age can invest, but in hedge fund, due to high risk, only accredited investors can invest. We have already discussed accredited investor, it means rich people. All right. Then in mutual fund, comparatively, this face more regulations. Mutual funds are regulated one, but the hedge funds, there are comparatively less regulations and compliances that you would see. Mutual funds, there's generally do not invest in derivatives, and hedge funds, they generally invest in the derivatives. Mutual funds, they are not allowed, but from a hedging perspective, you might see one or two contracts. But the hedge funds, they directly invest in derivatives as well. Then mutual funds, minimum investment is small in amount. You can start investing in mutual funds from 500, and in coming days, maybe it will be allowed from 100 even. All right, but in hedge fund here, minimum investing amount is huge. As I said, 1 crore, it means 10 million, which is required to invest in hedge funds, and the same applies to the private equity as well. Then pricing is done daily based on market price. In hedge fund, there is no requirement of daily pricing. Pricing, it means basically NAV calculation. You can calculate on a monthly basis also. Depends on the fund basically, whether it is daily dealing funds or monthly dealing funds, right? In mutual funds, the fund managers are less aggressive with predefined objective, but hedge fund managers, they are aggressive. Their style of investing is also aggressive. In mutual fund, you would see no contribution from fund managers. No contribution, it means if you want to establish your funds, then you don't need to invest anything, any single penny, means your money. But in hedge fund managers here have personal investment in funds as well. So in India, 20% fund managers contribution is required to invest in any funds. This is how Indian market works. But in US, which is not required. In mutual funds, involve less tax savings strategies as do not fall under tax bucket, and in hedge fund deploy more efficient tax saving strategies. The another strategies, these are available in the secondary market. So it means mutual funds which are available in secondary market, as I said, you can buy and sell, but the hedge funds, these are not available in the secondary market. So it means you can only buy and sell directly from the fund managers. You can sign PPM and directly purchase it from them. Then another one, there is a lot of disclosures requirement under mutual funds that you need to fulfill regulatory requirements, but under hedge fund there are comparatively less disclosures, so that you don't need to follow it. Last one is investors can usually enter and exit at their wish, but in hedge funds, which is not allowed. So this is how you can differentiate. If you see any question around, difference between hedge fund and mutual fund, I'm sure now you would be able to explain that. All right. I know that this is become a theoretical aspect, but I'm sure you would see questions around it. And if you don't know, then you won't be able to answer it. And that's what you should know it, theoretical plus, anyways, you should know the product, whether it is theoretical or whether it is, practical, that's fine. If you don't know it, then that doesn't make any sense at all. All right. So yeah, this is all about the difference between hedge fund and mutual fund. And of course, in terms of fees, you would see incentive fees calculation, which is something different. And now, means if you ask me from accounting perspective, see in mutual fund, you would see daily accounting, and in hedge fund, you would see generally it would be monthly accounting. So we compute the NAV monthly, but that doesn't mean we'll not calculate anything on monthly. We'll calculate that as well. So it depends on the fund's requirement basically. All right. So yeah, this was all about the strategies and even the difference between mutual fund and hedge fund. I'm sure now you would have got about what are the different strategies of hedge fund and also how we can differentiate mutual fund and hedge fund. So in short, if you ask my opinion, what is hedge fund and what is mutual fund? See, hedge fund is for rich people. Hedge fund is for wealthy people and institutions. Mutual fund is for poor people. Poor, it means like middle class people. All right, that's the difference. Anyways, I'm done with this session or module. We'll see you in next module on different topics. So we are going to touch to the practical NAV calculation, accounting, trade processing stuff and all. So be ready with that, even including accounting entries also. So we are going to start that portion very soon. So in next module you would see that. So where actually means we will touch to that portion. But coming module will also discuss about the process flow of fund accounting project. Now we have discussed about how your hedge fund structure is, then what are the strategies, then the pre-requirement of hedge funds and all. But now we'll discuss about the structure, it means accounting structure of a hedge fund, and then we'll start with the accounting part 2. All right, anyways, I'm done with this session. We'll see you in next session. Thank you very much.